Anurag Singh on the show with us. Anurag, hi, morning. Great to have you on the show, and thanks for joining in. The Anurag Fed's hawkish commentary. One would wonder whether this is anticipated because the markets don't seem to be, prepared for this, and they seem to be taking it quite badly.
Yeah. So, Aisha, look, and I think you know my view on this, and I've been holding this for quite some time. It depends on what camp you belong to. But I think if you, even at a high level, you look at the numbers, the PCE inflation number that Fed looks at, you see that since last Jan, it's barely budging. It's all moving between 4.56 to 5.1. And that's the range it is stuck in. And that's the core inflation that Fed is targeting. So I think I understand the market is tired. There is a sense that, well, you've already reached the range, touching about 5%, 4.75 to 5%. Inflation should come down, but inflation is a mindset and it's not complying really. So I think the honest judgment is that it is very sticky. And it is all dependent on wages. So I think we'll have to look at the JOLT numbers and other numbers coming out. But I think if somebody is saying that they are surprised by this commentary, I'm not really, because to me, it's really not surprising. And anybody who goes to the markets and, look at the prices, would know that this is not a surprising commentary by Chair Powell. And he always retains that card, right? At every sentence, he says, we will stay at it until the job is done. So I'm not quite surprised, but yeah, some market participants might be.
Sure, not very surprised by the commentary, Anurag, but do you also concur with the view that the rates will be much higher than what the consensus is at the moment? Right now, it's what, 5.35, what the street is working with, but the likes of Jamie Dimon, etc. also believe that level of 6 is something that you can't, completely shrug off. Your take, what the terminal rate could be?
Yeah. So Anisha, I think if I can just quickly take you back to, say, September 2021, that's when the Fed started talking about that they will be raising rates. Their estimate was that in next 1 year, the rates would be somewhere around like 0.5 to 1%. And look where we are, right? So the fact that Fed has not managed inflation as a problem in the last 40 years tells us that none of them have really faced this problem. And despite best intentions, it's very hard for anyone to really predict where it will be. My sense is that, I won't be surprised if we eventually touch 6%, because look, inflation is a mindset. It is what people expect. And I think Chair Powell said this repeatedly today as well. He has been off and on saying this. It has really got into the mindset. Even today now, if you look at the prices that are there in the market, it tells you that the corporates have already priced in for the next 6 months, wage hikes. So unless you break that cycle, it's not going to come down. So I won't be surprised, Anisha, if it touches 6%, because, let's put it like this. Whatever rate hikes have been done so far, they've all been absorbed by the economy. So we need a bigger kicker really, and that's a classic problem. Even in the 79, when the inflation was a huge problem, I think that's the conundrum the Federal Reserve faced, right? That the more they took the rate hikes, the more it was becoming entrenched and absorbed by the economy. Anisha.
Sure. Anurag, so what does one do at this point of time, an equity investor? Because do you think that the market is, as you said, is not pricing it enough? So, and as it is, there is a lot of bearish view coming in after the huge upsurge that we saw at the start of the year. What are you projecting with respect to what's the best strategy on a tactical basis at this point of time with respect to your funds and portfolio?
So Anisha, that's a great question. And it all depends on what kind of an investor you are. Now, look, I understand in case you are a mutual fund, you can't sit on more than 5% cash. So if the money comes in, you have to deploy it. And you really can't send the message in the market that, don't put the money now because the market is expensive. So I think that's something which is keeping the markets afloat, at least in India, right? And even passive flows out here, I think, is keeping the market afloat. And if you do not have a problem of billions, if you're running a fund in billions, then you, of course, can't sit out beyond a point. We don't have that problem. We are running a fund which is into millions. We can always take cash positions. And my declared position for the last 6 months has been that I'm 60% cash. Now it's like I'm 70% cash. Look, because Anisha, we don't, as a fund, it depends on your strategy. We don't have to be invested all the time, and we don't have to play these games on an everyday basis. We are value investors. We wait for the right opportunity. So I think that's the call from my side. But again, it depends on what kind of investor you are. If you are a SIP investor, probably you should continue, and you should be happy if the market corrects, because then you will buy the funds markets even cheaper, right? So I think these are kind of quick thoughts on where you stand. But if you see the avalanche coming, I can't really put my cash into the market. That will be foolish, and I can stay on 100% cash as well, waiting for the right opportunity. Anisha?
So hope the avalanche is some time away. Great to have you then on the show, Anurag. Good speaking with you as always.